Look, I need you to pay very close attention to what I'm about to tell you, because what's unfolding right now in the gold and silver markets isn't just another price move. This is different. And the timeline we're looking at? It's compressed in a way that should make anyone holding cash extremely uncomfortable. Let me start with something that happened just last week that barely made headlines. The COMEX reported a drawdown of registered gold inventory that, in percentage terms, was the largest single-week decline in over 3 years. We're talking about physical metal being pulled out of the exchange at a rate that would have been unthinkable even 6 months ago. And here's what makes this particularly interesting. It's happening while open interest remains elevated. Think about what that means. You've got more paper claims on gold than ever, while the actual physical metal available to settle those claims is shrinking rapidly. Now, I want you to understand something about market mechanics that most people miss. When you have a situation where paper claims vastly exceed physical supply, you're essentially sitting on a powder keg, and the fuse. It's already lit. We've seen this movie before, but never quite like this. In 1980, when gold hit its inflation-adjusted peak, the ratio of paper to physical was maybe 10 to 1. Today, conservative estimates put it at over 100 to 1. Some analysts I trust believe it's closer to 200 to 1. But here's where it gets really interesting. The entities pulling physical metal out of the COMEX aren't retail investors. They're not even your typical institutional players. We're seeing central banks, sovereign wealth funds, and what I can only describe as extremely well-informed money moving with an urgency that tells you they know something. When the People's Bank of China reports 18 consecutive months of gold purchases, and then you see similar patterns from India, Turkey, Poland, and even countries that historically held minimal gold reserves, you have to ask yourself, what do they see that the average investor doesn't? Let me paint you a picture of what's happening in the physical market right now. I've been talking to dealers, refiners, people who actually move metal around the world. And what they're telling me is that premiums on physical gold and silver have decoupled from spot prices in a way that's frankly unprecedented. You've got 1-ounce gold coins trading at 8 to 10% premiums over spot. Silver? Even worse. American silver eagles are commanding premiums of 40% or more in some markets. That's not normal market behavior. That's a shortage signal. And it's not just retail. The wholesale market is showing stress fractures. Refiners in Switzerland, which process something like 70% of the world's gold, are reporting wait times for delivery that have doubled. The London Bullion Market Association, which is essentially the wholesale hub for precious metals, has seen its available inventory drop to levels that would have triggered alarm bells a decade ago. But here's the thing, nobody's ringing those bells publicly. Why? Because the moment the broader market realizes there's a supply problem, the scramble begins. Now, let's talk about what's driving this. And I'm not talking about the surface-level narratives you hear on financial television. I'm talking about the structural forces that are reshaping the entire monetary system. The dollar's role as the global reserve currency is being challenged in ways that would have seemed impossible just 5 years ago. When Saudi Arabia signs oil deals denominated in yuan, when Brazil and Argentina create a common currency framework, when the BRICS nations announce plans for a gold-backed trade settlement system, these aren't just headlines. These are tectonic shifts. And here's what most people don't understand about de-dollarization. It's not a light switch. It's a process. And that process creates an enormous bid for gold because every country that wants to reduce its dollar exposure needs something to replace those reserves with. You can't just hold yuan or rubles or rupees in the same quantities you held dollars. The markets aren't deep enough. The only asset with sufficient liquidity and universal acceptance is gold. So what you're seeing is a multi-year, multi-trillion-dollar reallocation that's just getting started. But the timeline I mentioned at the beginning, the reason you have days, not weeks, that's because of something specific that's about to happen. The COMEX has a delivery month coming up, and the amount of gold standing for delivery is absolutely staggering. We're talking about demands for physical delivery that exceed available registered inventory by a significant margin. Now, historically, when this happens, the exchange has ways of managing it. They can incentivize cash settlement. They can adjust margin requirements. They can do a lot of things to prevent what's called a delivery default. But here's the problem. The entities standing for delivery this time aren't the usual suspects. These aren't traders looking to flip contracts. These are buyers who want the metal, period. And they have the financial resources to take delivery and the storage capacity to hold it. If even a fraction of these delivery demands are pressed, the COMEX faces a choice: default on contracts or drain registered inventory to levels that would effectively shut down the exchange's ability to function as a price discovery mechanism. Let me tell you what happened in a similar situation back in the silver market. This was early in the last decade. A large buyer stood for delivery of physical silver in quantities that stressed the system. The COMEX changed the rules mid-game, essentially forcing cash settlement. The price of silver dropped 30% in a matter of days. But here's the thing. That buyer got paid in cash at the lower price and then turned around and bought physical silver in the spot market at those depressed prices. They ended up with more metal than they would have gotten through delivery. The exchange protected itself, but it revealed the fragility of the paper market. Now imagine that scenario playing out in gold, with multiple large buyers, in a market where physical premiums are already elevated and where geopolitical tensions are running hot. The potential for a disorderly repricing is very real. And when I say disorderly, I'm not talking about a 10 or 20% move. I'm talking about the kind of gap that happens when a market structure breaks. Here's something else you need to understand about the current setup. The commercial banks that act as market makers in precious metals, the ones who sell the paper contracts and manage the hedging, they're positioned in a way that's extremely unusual. Normally, these banks are net short gold. They sell contracts to speculators and hedge their exposure in various ways. But right now, the commitment of traders' data shows commercial short positions at multi-year lows. They've been covering aggressively. That tells you that the smart money, the people who have the best information about supply and demand, are getting out of the way. And when the commercials step aside, when they're not willing to sell paper into a rising market, that's when you get explosive moves. Because the natural sellers disappear, and suddenly every buyer is chasing a limited supply. We saw this in 2011 when gold went from $1,400 to $1,900 in a matter of months. We saw it in 2020 when gold broke through $2,000. And we're seeing the setup for it again right now, except this time the fundamental backdrop is even more compelling. Let me shift gears for a second and talk about something that's relevant if you're sitting on significant retirement savings. If you've got $100,000 or more in traditional retirement accounts, IRAs, 401ks, that kind of thing, there's a mechanism that lets you hold physical gold inside those accounts without triggering taxes or penalties. I put together a free guide that walks through exactly how gold IRAs work, what the rules are, how the process works. It's in the description below. Not trying to sell you anything, just want to make sure you know that option exists if it's relevant to your situation. All right, back to what's happening in the market. So we've established that physical supply is tight, that major players are accumulating, that the paper market is showing stress. But let's talk about the demand side because that's where things get really interesting. Industrial demand for silver, which is about 60% of total demand, is accelerating. The solar panel industry alone is projected to consume over 200 million ounces of silver annually by the end of next year. Electric vehicles use 2 to 3 times more silver than traditional cars. 5G infrastructure, which is being built out globally, is incredibly silver intensive. And here's the kicker. There's no substitute for silver in most of these applications. It's the most conductive metal, the most reflective metal, and it has unique properties that make it irreplaceable in electronics and green energy technologies. So you've got structural demand that's growing exponentially, while mine supply is essentially flat. Primary silver mines, mines that exist specifically to extract silver, are rare. Most silver comes as a byproduct of copper, lead, and zinc mining. So when those base metal prices are low, silver production drops even if silver prices are high. We're in a situation right now where the silver market has run a supply deficit for 3 consecutive years. That means more silver is being consumed than is being mined. The gap is being filled by above-ground inventories, recycling, and investor selling. But those sources are finite. And when you look at the data on investor holdings, particularly in silver ETFs, you see that those inventories have been declining. The metal is moving from weak hands to strong hands, from investors who are selling into price strength to buyers who are accumulating for the long term. Now, let's connect this back to gold, because the two metals are linked in ways that most people don't fully appreciate. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15:1. That's roughly the ratio at which the metals occur in the Earth's crust. For most of human history, that's where the ratio traded. But in modern times, it's been much higher. Right now, it's hovering around 80:1. What that means is that silver is historically cheap relative to gold. And when you have a situation where both metals are in supply deficit, where both are being accumulated by sophisticated buyers, the metal that's more undervalued tends to outperform. We saw this in 2011 when silver went from $18 to nearly $50 in a matter of months, while gold went from $1,400 to $1,900. Silver moved almost 3 times as much in percentage terms. But here's what I want you to understand about the timeline. The reason I'm saying you have days, not weeks, is because the technical setup in both gold and silver is at a critical juncture. Gold is testing resistance levels that, if broken, open up a clear path to $3,000. Silver is coiled at a level where a breakout would likely trigger algorithmic buying and short covering that could send it to $40 very quickly. And the fundamental backdrop, the supply-demand situation, the geopolitical tensions, the monetary policy environment, all of it is supportive of a major move. Let me tell you about a pattern I've noticed in precious metals markets over the years. The big moves, the ones that really matter, they don't happen gradually. They happen in bursts. You'll have months of consolidation, of sideways trading, of frustration for anyone who's positioned for a move. And then, seemingly out of nowhere, the market gaps higher and doesn't look back. It happened in 2008 when gold went from 700 to 1,000 in a matter of weeks during the financial crisis. It happened in 2020 when gold broke through 2,000 during the pandemic. And the setup right now looks eerily similar. What triggers these moves? Usually, it's a catalyst that forces a repricing of risk. In 2008, it was the collapse of Lehman Brothers. In 2020, it was the realization that central banks were going to print unlimited amounts of money. Right now, the potential catalysts are numerous. You've got a banking system that's still fragile despite what the headlines say. You've got commercial real estate exposure that's going to hit bank balance sheets hard. You've got geopolitical tensions that could escalate quickly. You've got a debt ceiling debate coming up that could shake confidence in U.S. fiscal stability. Any one of these could be the spark. But here's the thing. You don't need a crisis for gold and silver to move higher. The structural bid from central banks, the supply deficits, the technical breakouts, these are sufficient on their own. A crisis would just accelerate the timeline and amplify the magnitude. Now, I want to talk about something that doesn't get discussed enough. The role of derivatives in the precious metals market. The paper market, the futures and options that trade on exchanges, they're supposed to be a price discovery mechanism. But when the notional value of derivatives exceeds the value of the underlying physical market by orders of magnitude, you don't have price discovery. You have price suppression. And that suppression can only last as long as the physical market remains liquid. We're seeing signs that liquidity is drying up. The bid-ask spreads in the wholesale market have widened. The time to settle large transactions has increased. The premiums on physical metal have diverged from paper prices. These are all symptoms of a market under stress. And when a market under stress meets a catalyst, the result is usually a violent repricing. Let me give you a historical parallel that I think is instructive. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, the price of gold was $35 an ounce. Within 9 years, it had gone to over $800. That's a 23-fold increase. Now, I'm not predicting that kind of move from current levels, but I want you to understand the magnitude of repricing that can happen when a monetary system undergoes fundamental change. And make no mistake, we are in the early stages of fundamental change. The Bretton Woods system that established the dollar as the global reserve currency is being challenged. The petrodollar system that recycled oil revenues into U.S. treasuries is breaking down. The assumption that the dollar will always be the dominant store of value is being questioned by countries that represent more than half of global GDP. When that kind of change happens, gold doesn't just go up because of inflation or because of fear. It goes up because it's being remonetized. It's returning to its historical role as the ultimate form of money, the asset that has no counterparty risk, that can't be printed or debased, that has maintained its purchasing power for thousands of years. And silver? Silver is gold's little brother. It moves with gold, but with more volatility, more upside potential, and more industrial demand supporting the floor. If gold is remonetizing, silver is both remonetizing and becoming increasingly critical to the technological infrastructure of the modern world. So, when I say you have days, not weeks, I'm basing that on a confluence of factors that are all pointing in the same direction. The technical setup is primed. The fundamental backdrop is supportive. The supply-demand dynamics are tight. The geopolitical environment is tense. The monetary system is in transition, and the smart money is positioned for a move. What does that mean for you? It means that if you've been thinking about adding precious metals exposure, if you've been waiting for the right time, if you've been on the fence, the window is closing. Not in some abstract future sense, but in a very real, very immediate sense. Because once the move starts, once gold breaks through key resistance and silver follows, the opportunity to position at current levels will be gone. And here's the thing about precious metals. They're not like stocks where you can just click a button and own them instantly. Physical metal takes time to acquire, especially in size. Dealers have limited inventory. Premiums spike when demand surges. Delivery times extend. If you wait until the move is obvious to everyone, you'll be competing with a flood of buyers, paying elevated premiums, and waiting weeks or months for delivery. The smart money doesn't wait for confirmation. They position ahead of the move, when prices are still reasonable, when supply is still available, when they can accumulate without moving the market. That's what central banks are doing right now. That's what sovereign wealth funds are doing. That's what the most sophisticated investors in the world are doing. Now I want to address something that I know some of you are thinking. You're thinking, I've heard this before. I've heard that gold and silver are about to explode, and then they don't. And you're right to be skeptical. There have been false starts. There have been predictions that didn't pan out. But here's what's different this time. The fundamentals have never been this compelling. The supply situation has never been this tight. The geopolitical backdrop has never been this supportive. The technical setup has never been this clean. This isn't about hope or speculation. This is about reading the market structure, understanding the forces at play, and recognizing when all the pieces are aligned. And right now, they are. The question isn't whether gold and silver are going higher. The question is, how much higher and how fast? And based on everything I'm seeing, the answers are significantly and soon. Let me leave you with this thought. In every major financial crisis, in every period of monetary instability, in every era of geopolitical tension, gold and silver have served as the ultimate safe haven. They've preserved wealth when currencies failed. They've provided liquidity when markets froze. They've maintained purchasing power when inflation raged. We're entering a period that has elements of all of those historical episodes. Currency instability? Check. Geopolitical tension? Check. Inflation concerns? Check. Banking system fragility? Check. And in this environment, with supply tight and demand surging, with central banks accumulating and the paper market showing stress, the setup for precious metals is as compelling as it's ever been. You have days, not weeks, to position for what's coming. The move is going to happen with or without you. The only question is whether you'll be positioned to benefit from it or watching from the sidelines wishing you had acted when you had the chance. The information is in front of you. The opportunity is available. What you do with it is up to you.